The first corporate on the show, Lemon Tree. The company reported a steady Q4, revenue surging 15.5%. Occupancy has improved on a year-on-year basis, and the total debt of the company has declined by 10% on a year-on-year basis. Patanjali Govind Keswani, Chairman and Managing Director of the company, is now with us on the show. Thank you very much, sir, for joining in. If you could give us an indication of how Q1 has been so far in terms of occupancy and the outlook that you have for the rest of the year in terms of ARR and occupancy. Do you think you can push it higher compared to last year?
Hi, Reema. I think certainly we will have higher occupancy in Q1 this year than last year, because last year in our hotel in Bombay, which is 15% of our inventory, was relatively new, and this year it has stabilized, which is the Aurika.
Right.
I think April, in and of itself, was a fabulous month. In May, two things occurred. One was this war, and one was this rise in cases of COVID. So that affected demand. But if I looked at it in the aggregate, I would say we would do about 15% better in revenue terms in this quarter vis-a-vis last year.
The entire year, what would your target be? Because last year was incredible. If you look at the entire year, you've done 20% revenue growth. Your margins have maintained that 50% mark as well. So first quarter notwithstanding, 15% for the remainder of this year. What's the guidance that you're giving?
It would be roughly mid-teens. So, guidance in the hotel business is like shooting in the dark.
True.
Because, sudden events can very significantly affect demand. So if I gave you a range, it would be, mid-teens plus minus 2%.
Truth to be told, in the VUCA world that we're in, guidance in any sector would perhaps be shooting in the dark, but, a little more for the hospitality space itself. In terms of capacity addition, that's where you have visibility. What's the kind of addition that you've lined up for in FY26 and FY27? And how much will occupancy scale up basis those additions?
Occupancy is a percentage. So I assume you're talking in terms of units or room nights.
No, I'm talking about room nights getting added, plus your occupancy in those room nights scaling up.
So Mangalam, it's very simple. We had given guidance 2 years ago that in 5 years we would hit 20,000 rooms.
Yes.
But I think we'll cross it this year, number one. Number two is, so we will give a fresh plan for 2030, because we are meeting all the set targets actually a year or two before we said we would. Number two is that we are already at, I think, 17,200 rooms. So we just need to add 2,800, which will certainly happen this year. Our occupancy is a sum of mature hotels and new hotels. It is the weighted average. So a new hotel naturally takes more time to scale up.
Yep.
So when you aggressively add new hotels, the occupancy of those hotels is always much less and brings the weighted average down.
Exactly.
That happened to us, for example, with Aurika and Bombay. So this year, I think our total occupancy was a touch under 72%. I'm pretty sure we'll do better than that this year. And my broad expectation is, based on how I see, change in consumer behavior, an inclination by a larger number of consumers for branded hotels. My broad guess is that Lemon Tree's occupancy will be 76 to 78%, 12 months forward. So that's how I'm looking at it. We will cross 20,000 rooms, and we will be selling, something like 16,000 rooms on a steady basis at that level of control over supply.
And just for bookkeeping, typically for a new hotel, what's the break-even occupancy?
Well, if we design it and build it on an OPEX basis, it would be 21 to 23%. If you add debt, which is, I'm assuming that you have leveraged carefully and, you have loan to value is 50%, then typically you can pay your interest by about 30-35%, and you can pay your principal by 40-45%. So as long as we hit 50% occupancy, we basically pay for everything, and after that it's to the bottom line.
Since you're going to overshoot the capacity addition target of 20,000, what about on the debt front? You had guided to be debt-free by FY28. You lowered your debt by 10% last year. By FY26 end, what would the debt number stand at, and FY27 end?
I don't think it'll be, I think it'll drop by another 20%. But if we, as we said, most of our debt is in our joint venture, which we own 60% of, where the earnings growth has been quite significant. So best guess is we will definitely meet that timeline. But if we list Fleur, then we'll go debt-free, at that time. So debt-free 100% in 3 years. If we list Fleur before that, we'll be debt-free before that. And end of this year, we'll be, if we don't list Fleur, we'll be another 20% down.
Your ARR is about 7,042. In Q4, it went up by 7%. What's the outlook on the average room rent?
See, our room rents, we expect, see, when I say we'll grow 15% in revenue, my broad guess is that 1/3 of that will be by occupancy. So say 72 will become 75. And another 2/3 of that will be by rate increase, which is a good sign, by the way, because rate increase goes straight to your bottom line. Occupancy increase has some implied variable cost.
So, speaking about straight to your bottom line, the other thing that goes straight to your bottom line is management fees. You did about, 45 crores in the fourth quarter. What is the quarterly run rate likely to be? And by when do you reach that 300-350 crore annual management fee target?
We'll reach it in 2 years, for sure.
Okay.
But I can't give you an annual or a quarter. It's so much a function, Mangalam, of the hotel opening on time. So if we have a plan that, we'll open 10 hotels in this half year, and only 6 open and another 4 get pushed forward to the next half year, then it changes these numbers. I would look at run rate. So what I'm saying is our run rate by end of next year should be 25 crores a month.
Is supply becoming a problem? Because now everyone's looking at hospitality as a big, tailwind sector for the next 10 years or so, where the macros are favoring the overall sector. For so many players coming in, so many properties, is real estate supply and the cost of acquiring a new hotel increasing?
In fact, that's the good news, because if you put supply up at current costs, what it means is that it makes money at current costs. And what about the guys who have hotels on book value? So in that sense, an incumbent who has an existing hotel, has a much lower investment cost than somebody who's opened a hotel in that same location now. So typically the construction cost doubles every 7 years, 7, 8, 9 years, depending. So if I put up a hotel 10 years ago and I'm getting and somebody puts up a hotel today and gets a 12% return, then our hotel will get a 24% return because its book value or its cost of construction was, half of the the later guy. So I believe that supply is very necessary in India for 2 reasons. One is for consolidation rather than fragmentation. Number 2, for quality. Number 3, for competitiveness. And most importantly, I believe supply creates demand. So the more supply you create in the hotel sector, the more demand you create, basically.
Mr. Keswani, just mathematically, if 2/3 of your revenue comes in from an increase in the cost of a hotel room, what would that number stand at, the ARR, by the end of FY26? And are we in for, Mangalam was just talking about how the industry itself has structural tailwinds. Do you think the ARR can keep compounding at that, growth rate?
I'm actually, Reema, I keep saying this. Our current room rate is 20% less than what it was, 17 years ago. On an absolute rupee basis, forget inflation. So the good news for the hotel sectors, I expect room rates will continue accelerating, and they will accelerate to a point when it will be closer to the mean, which is the global mean. Number 2, as you know, pricing is a function of supply and demand. So no new supply will come up if the price is not right to give a return to that new supply. So why would I put up a hotel for, say, 250 crores to get a return of 10 crores? but that is what an old hotel may be generating today. So this is self-balancing. And I am pretty sure prices, I keep saying this, nobody believes me, but I'm pretty sure prices will be double in 3 years.
You had said that last year as well, and you said that the year before that as well, and it's been the case. So 3 years ago, what the prices were versus what the prices are right now, it has almost doubled, if not doubled. Just a final question. You earlier also pointed out the possibility of the demerger of, assets and brands, because that's how globally the business is structured. What's the update for Lemon Tree on that? Have you considered anything in the very near future?
No, we will, as these are various routes to getting, de-aggregating or disaggregating the management asset-light business from the asset-heavy ownership business. It is very much one of the options we will consider, but our view is that we will list Fleur in some form or the other, and that is the asset-heavy side of our business. So sure, it is what you just mentioned, Mangalam, is one of those.
Thank you, Mr. Keswani, for joining in. Always a pleasure chatting with you about the company and the industry. We wish you all the best. Well, get into breaks, but we are very, very excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime every day at 12 noon for the Global Reset and the Global Lens at 8:30 p.m.